Hello, everyone, and welcome to the to our second quarter Diamond Trends webinar. My name is Avi, and I'm going to spend the next hour or so with you trying to understand what's happening in the diamond market, what happened in the diamond market in the second quarter. Thank you for taking time out to join us. It's much appreciated in these busy and challenging times. So I'm looking forward to spending some time with you. I'm going to try and limit my presentation to around 45, 50 minutes, and then we'll open it up to some questions. So feel free to type your questions into the Q&A section of the Zoom application. Okay, so what are our goals? We've been holding these webinars on a quarterly basis for I think about 2 years now. Lately, there's been this explosion of webinars going on in the industry. But what are our goals for the next hour? And when we look at the market, we want to assess the performance of the diamond industry during the pandemic so far. That's looking at the second quarter primarily, and in the context of the first half as a whole. We want to look at what changes have taken effect throughout the pipeline in this very short time period, and what factors are driving the market and influencing polished prices, which is a big question to tackle. We are interested to find out what changes that have taken place are going to stick around for the long term. And so I'm going to make a few suggestions over there, and then a brief look at what opportunities there are in the market. There's the famous quote from Winston Churchill that's been quoted ad nauseum, and I promised myself I wouldn't quote him, but it's to never let a good crisis go to waste, and so there is opportunity in this market environment for the industry. Before I start, I would like to make a disclaimer or two and put into context my role in the industry. And I'm very aware that I'm not a business owner. And so when I look at the market, it's from a different point of view. It's not from my own business and what I'm doing on a micro level. I'm looking at the market on a very macro level. So I would appreciate it if you kept that in mind, and not take it as anything I say as sort of business advice or any consultation in any way. And the second is how we derive our opinion of the market or my view of the market, and it's from a number of sources. The first is that we're covering the diamond industry on diamonds.net in our news feed on a daily basis, and so a lot of what I'm presenting is based on news that's happening in the industry on a daily basis. Secondly, at the Rapaport group, we have a daily meeting amongst the management meeting, in which we're giving feedback and receiving feedback about what's happening in different markets in our different offices around the world. And so there's interesting information that's coming out of that. In addition to that, we have a weekly price call where various businesses and business units within the Rapaport group and various offices are giving feedback on the market intelligence that they've gathered from the markets and what's happening in their respective countries, and that's very relevant in the COVID environment. And so I'm aggregating a lot of the information from those various sources. And then I would also like to just thank Shimon Gerstensang, who is our head of pricing at Rapaport, who helps gives me such tremendous help to gain some perspective of the market and understanding of what's happening out there. So let's get to it. And as we did in our last webinar, I'd like to start off by giving an outline of the diamond supply chain. How is the diamond? What journey is the diamond taking as it moves through various stages along the pipeline to the consumer. So it starts at the mining level, that the miners are extracting rough from the ground, they're sorting and aggregating it within their own systems, and then selling it to the trade. The rough buyers are either manufacturing the goods into polished, or dealing it amongst themselves before it's manufactured into polished. The manufacturing sector polishes those rough diamonds into beautiful polished stones. Then the diamonds are traded within the dealer market before being sold to jewelry wholesale, to be set into a piece of jewelry, so a collection of jewelry, which is then moved on to the retail sector, and the retail jeweler will then sell it to the end consumer. So that's a very linear look at how the diamond markets, what the diamond journey entails. It's obviously much more complicated than that, and it's not a linear journey. You have miners selling polished, and the manufacturers selling at retail, and at wholesale selling finished jewelry, etc. And the point that I'll make later, and go into a bit deeper, is that in the COVID environment, that linear structure has been eroded away a little bit more. But it's important as we analyze what's the effect that the economic downturn has had on the industry, that we look at various components of the market, and this gives us a good picture of where we stand. Coming into the crisis, the market didn't have a great year in 2019, and there were significant movements. Rough production fell by about 7%, by value, according to the Kimberley process, and that was largely as miners responded to, miners had peak production in the previous years, and so it was inevitable that they were going to decline, but there was also some response to lower rough sales, as manufacturers were dealing with an inflated inventory in the midstream that we spoke about so often, and was having such an effect on polished prices in 2018, 2019. And so they pulled back on their rough buying because they had enough polished inventory to satisfy their needs. At the same time, the polished market contracted by about 15%, and that was largely as a result of caution out of China. I would say that as the trade war between the US and China sort of heated up, it affected some caution into the Chinese market and affected some buying there. But overall, polished sales fell by about 16%. And our estimates are that some jewelry sales rose marginally by about 1%. And so there was, the point here is that there was some realignment. The industry was already aware of its inventory issues. Or was acutely aware of its inventory issues in 2019. And so as I move through the pipeline and see what happened in the first half of the year, my goal is not to fill in the numbers for the first half of 2020. The truth is we don't have the full gambit of data to inform us to fill out the table for the first half, so I'd rather not do it. But the idea is really to understand the trends behind the numbers that I'm going to present to you, and I hope you've got your graph goggles on, because there's a lot of Excel coming up, but I'm going to move quite quickly through them, and it's really more about the trend behind the numbers that I want us to think about, and also to keep in mind two things, and that is, what is happening in terms of inventory levels and inventory movement within the pipeline, and also in terms of what effect that would have on prices, on polished prices. Okay, so what happened with polished prices was quite surprising, actually, in the second quarter, when you consider the state of the market. That our RAPI index, which is our sort of go-to to give a picture of what's happening in terms of the market, rose in the second quarter. That's after a sharp decrease in the first quarter. It's a complicated story that we're going to get into what influence polished prices. Ideally, we want in a healthy market, polished prices will be pulled upward by an increase in consumer demand. Clearly, that didn't happen in the second quarter or in 2020 in general. So what influenced polished prices to firm in the second quarter? And we'll get into that a bit later. But I wanted to, it's almost like a tradition, this graph that I like to present, that as a snapshot of what's to come. That uptrend, by the way, continued into July, and we continue to see a firming of prices. But we'll get into why why we think that is a bit further on. Okay, so just in terms of where we're standing at the moment in terms of the coronavirus, and when it was around June, there was as economies started to reopen, in Europe, here in Israel, in the United States, there was kind of this feeling that the worst is behind us. We're able to go back to work, and how wrong we were. We've seen that we need to exert extreme caution when reopening the economy, and the new cases that are being reported continues to rise. And so we need to keep that in mind, because it's still a very difficult environment to operate in on so many levels, and we'll get into that. But I will take this opportunity to encourage everyone to wear their masks and keep social distancing as much as possible, because that's really the only way that we're going to flatten that curve until a vaccine comes into play. And that's something that as an industry we need to keep aware of. That to quote a certain president, the worst may still be to come, and that's just the reality of the situation. But having said that, there is acclimation. We become more acclimatized to how to deal with it. And I think as we recognize the reality of the situation, there are ways to engage with each other and to conduct business and to open up the economy in a cautious manner. Martin Rapaport, our chairman, in a webinar a month or two ago, outlined this infographic, presented this infographic to the audience, in which he outlined 4 areas that the coronavirus is impacting our society. It has a physical impact on us. It's not easy to hug a person anymore, with caution. Economically, it's having a devastating effect. Socially, it's changed our social norms. That we're shifting to meeting our friends largely online, and be it through Zoom or whatever the case is, and it changes that interaction. And emotionally, it's naturally going to have an effect on us, both in terms of how we view the world, but also in terms of how we view our lives, and putting into perspective what's important, what's meaningful in our everyday lives. And so when we look at how the coronavirus has affected the consumer, we've got to think of the consumer as ourselves. Firstly, we're all consumers, and think of how it has affected our daily tasks. And so there's a certain, it's fed into economic and social uncertainty. There is naturally, when we're in a downturn situation, there's a shift from non-essential spending to spending on essential items. In this case, in the coronavirus, there's been a shift to a stay-at-home economy, in which we're working from home, where our entertainment is largely at home. And so things like Going out to a restaurant is not taken for granted. And as I said, our entertainment and shopping is certainly it comes into that. I, for one, am doing more of my grocery shopping online, which is something I never used to do. But it's kind of enjoyable, I must say. I don't miss going to the grocery store. Anyway, the point is that we are in a digitized economy. And as an industry, the diamond and jewelry trade from across the supply chain needs to understand how it can engage with the consumer in a digitized way. But because it's such a beautifully human product, we need to be able to humanize that digital experience. And part of that is that consumers are looking for trust in the brands, in the products that they're buying online. And we need to feed into that trend and ensure that we're a trustworthy industry and product to the consumer. With all that in mind, there is the United States and other countries as well are in record unemployment numbers that peaked sort of in April and then came down a bit in May and June. But the point is that we're still above 10% unemployment, and so people are hurting, and we can't take these things for granted, and got to understand where they might spend their hard-earned dollar or hard-saved dollar when they're ready to spend that. Look at the retail market. I chose two companies to look at. Because the data was available, they've reported, and because they present, I think, a fair reflection of what's going on globally. And when we look at Richemont, which is the owner of the Cartier and Van Cleef brands, in the second quarter, for April to June quarter, they showed 60% declines in most markets in Europe, Americas, and Japan. In Asia Pacific, there was a softer decline, and that was largely supported by an increase in China, which Richemont said they had 49% year-on-year growth in their sales during the period in China. And there's been a lot of talk about China having a strong recovery after coming out of lockdown. And I think we need to move with some caution to extrapolate the experience in China to other markets, because there is some expectation that if China is showing a 49% increase in, having, and it's 2 months ahead of the rest of the world, that we're going to see that increase in other markets. I don't think it's the case. I think there's something to be said about the cultural experience in China, and the ability that consumers there to sort of follow the rules more closely than they would in the United States. But I don't want to go into that too deeply. Looking at China a bit more, and I do think that Richemont may be an outlier. The luxury market, the high-end luxury market, has really outperformed in previous years, and maybe when the highs are high and the lows are low. But we'll have a better picture maybe in the next quarter if that's true or not, and when some of the other US-based retailers report their earnings. What we do see in China from Chow Tai Fook, which is the largest jewelry retailer in Hong Kong, China, is that the decline in same-store sales was 11%, which I think maybe reflects more of the reality of what's really going on. And in Hong Kong, it's deep double digits declines that have been fairly consistent through the past year, as Hong Kong has had to deal with geopolitical issues on top of the coronavirus challenge. I do think that this is a transition period for luxury houses in how they look at Hong Kong and China, and that we are starting to see a shift out of Hong Kong from the luxury houses into mainland China, and possibly Macau has what to gain from that sentiment as well. Chow Tai Fook is closing stores slowly in Hong Kong and opening new ones in China. There was a strong net increase in its store openings in mainland China during the quarter, so that's quite telling as well, I think. But that's the retail. Retail, we continue to see declines for the second quarter, and it'll be interesting to see what happens in the third quarter as economies open up and retailers have the physical ability to sell. In the US, the one interesting data piece that we got yesterday, in fact, or last week, sorry, was from the Jewelers Board of Trade, who does a quarterly update on businesses that discontinued during a quarter, and we see that there wasn't such a big decline. This is the number of jewelry businesses that the JBT tracks in the United States, and there wasn't such a big decline. It was fairly on trend from previous quarters. There is more to the data than that. The JBT noted that there was a difficulty in confirming that if a company closed or not. Goes to quite great lengths to make that confirmation before adding it to the data. And so there might be a bit of a lag in the number of companies that close, be it because of bankruptcy or just closing up shop, whatever the case may be. The one interesting thing from our point of view, which I think is telling for the market, is that there was an increase in downgrades of credit ratings that the JBT enacted. The JBT being a ratings agency essentially for the jewelry industry, and they said that there was an increase in companies that are given 90 days to pay their bills from a supplier and missed those payments, so it affected their credit rating. And so that's something that we've got to keep in mind, that it's affecting the market as well. When we look at the retail experience in the second quarter, I think there are a number of points that are worth mentioning. First is that there's the reopening is gradual. Standalone stores, from the conversations that we've had with retailers and those in the retail market in the US, at least, standalone stores are doing better than mall-based locations. Some states are doing better than others, and some states have had to reclose their operations and go back into lockdown. The payment protection program propped up businesses to some extent, and there is some uncertainty as to whether further stimulus will be available moving forward. I think, and I'll address this a bit further on again, is that I think there is some pent-up demand that we can look forward to in the fourth quarter. Every day I look with awe and some sense of disappointment from a personal point of view at the markets as they continue to reach record highs. It's crazy, but we always talk about the wealth effect that markets have on jewelry buying, and so one would expect that as people's perception of their wealth and their actual wealth in terms of the assets that they hold has increased with the stock market, that there's a segment of society that is going to be ready to spend in the fourth quarter, and that's quite encouraging for us. The engagement ring markets, we continue to see surveys that show that bridal continues to be strong, and that as people come out of lockdown or are still in some sort of a lockdown situation, they want to get on with things and engage in some meaningful emotion and understand what's important to them. So there's a sort of a spurt in engagement demand that we can expect, I think. The emphasis has been on multi-channel and humanizing the online shopping experience. Retailers introducing things like virtual appointments, really using social media. I think it's so crucial now that the ability to sell via social media is becoming much easier and much more accessible, and that's something that jewelry retail is starting to take advantage of. And then finally, that jewelers had enough inventory to satisfy demand in the second quarter. There was no need for them to go into the polished market and buy diamonds, and that takes us to the polished market, because it's understandable then that the US imports of polished diamonds fell so dramatically in the second quarter. And this is a monthly graph that shows really minimal imports in April and around 320 million worth in May. May is usually a peak month for imports to the United States, I think mainly because of the JCK show that's so important to the trade, people sending goods for the show, and the US market becomes really a focal point during the month. That didn't happen this month. JCK had to cancel its physical show and is holding a virtual one in August, which should be interesting. But the point is that this demonstrates to what extent demand in the US fell during that lockdown period. Similarly, in India being the largest producer of polished diamonds, its exports in the second quarter fell 75% year on year, and again indicative of the level of demand, the ability to ship goods and physically engage and make a transaction. So, in terms of the polished market, and I'm kind of repeating this point, and it might come up again, is that jewelers had enough inventory to satisfy current demand, and that's really had a trickle-down effect on the rest of the market. Their buying became very specific. That if they and there was no inventory, bulk inventory replacement that we might usually see from the jewelry sector. There's also been an erosion of the dealer market, which is very important when it comes to understanding pricing, and we'll come back to that point a bit later on. Secondly, as I mentioned, there've been delays in shipments that have affected demand in the polished market, and the ability of companies to do business. It's restraining that ability to do business, and again we'll come back to that point. In the manufacturing sector, when we look at India being the main hub of manufacturing diamonds from rough to polished, the rough intake fell by 89% during the quarter, and that's again as cutters themselves had enough inventory to satisfy polished demand. So they they could work with existing polished inventory to satisfy any orders that would come in, and they also had enough rough to satisfy any manufacturing that they were able to do. As we saw in January and February, there was actually quite a high level of rough buying in the market before coronavirus became a pandemic and spread to the rest of the globe. And so the manufacturers started the lockdown with a lot of rough in inventory, and so they could work off their existing stockpiles through at least the second quarter, and I think also through the third quarter, but that remains to be seen. So manufacturing at the same time has been significantly reduced as factories are limited in the number of workers that could attend work, could work on the chain, and India itself the industry put itself on a voluntary moratorium on rough imports. I don't think it was really necessary because no one wanted to buy rough anyway. But I think the messaging was that the industry was trying to show a united voice that this is what needs to be done from a supply point of view, to realign and help us navigate the market. India's had a very difficult reopening. It's been very stop-start and is really still in the midst of its peak pandemic, peak coronavirus infection rate. And firstly, we wish them well, but it affects the ability to get back to work and certainly for the factories to start working again. In terms of the rough markets, it follows from manufacturing. Belgium being the main rough trading hub, saw 80% declines in imports, exports, and that affects the mining company sales. If no one's buying rough, the mining companies aren't selling rough, and so the combined sales of Alrosa and De Beers in the second quarter fell by 94%. They're usually selling between the two major producers in a quarter are selling above, around $2 billion worth. Their combined sales were below 400 million, I think, and so that's again an indication of what's happening out there, and the lack of appetite for rough. And so the rough sales were affected by the lack of demand as manufacturers shut down. It was also challenging for mining companies to physically hold their sales. That there were strict travel restrictions for a site holder to get to Botswana to attend a site. Forced initially De Beers to cancel their sale in March, I think it was. And so the major producers have had to rethink where they're selling their diamonds. Antwerp seems to be a beneficiary of that strategy rethink, or temporary move, albeit. And other miners are, and the majors included, are shifting to digital tenders. And I think this is a very important trend that's been accelerated during the coronavirus experience. Digital tenders also feed into another trend that we're watching very closely, and that is the mining company's ability to customize demand. As customers rough demand according to the polished, the manufacturer's needs, polishing needs, which is something that we're going to continue to look out for. When we look at rough mining, production fell by this graph shows the combined production and sales volume of Alrosa, De Beers, and Mountain Province. Mountain Province co-owns the Gachagua mine with De Beers, so it's looking at the full De Beers portfolio with Alrosa. And we see that production, they were able to reduce production by a certain extent, but not fully, and it's very difficult to and costly to temporarily close a mine or to reduce production. And so while they kept production at a certain level, albeit quite significantly reduced, their sales volume fell by 91%. And that gap between the blue bar and the orange is where the inventory is being held at the moment, and that the mining companies, as they continue to produce and lack the ability to sell, are holding a lot of rough in their vaults. And we saw that already developing in 2019, as in the second half of 2019, as this graph demonstrates, but it's certainly being added to in the second quarter. Interestingly, that first quarter was a good quarter in terms of sales, in terms of rough sales. It's difficult. It's not so easy to remember that far back. Anyway, as we move on, when we look at the state of the miners, there are three different segments within the diamond mining industry. They're the majors, which I would categorize, as in no particular order, in alphabetical order. Sometimes they're sensitive to this. Alrosa, De Beers, and Rio Tinto have the volume to sell via long-term contracts. And then there's the mid-tier miners, the likes of Petra Diamonds, Dominion, Mountain Province, Lucara. I would also include Gem Diamonds in that. And then the smaller operations that have one small mine that they're producing rough. Amongst the majors, they reduced their production guidance and their production plan for 2020, but they have to maintain the operations at a certain level. At the same time, they have implemented a flexible policy in terms of allowing manufacturers to not honor their contracts that they have for supply. In other words, they don't have to take goods during this period, and so that's resulted in a large inventory buildup amongst the major miners. They started 2020 with large inventory as it is, But having said that, there is a feeling that that they have the balance sheet to help them navigate this difficult market environment, and in some cases outside support. We understand that Alrosa is negotiating to sell a certain volume of goods to Gokran, which is essentially the Russian treasury. And so the mid-tiers seem to be having a harder time, or some of the mid-tiers that have taken out high debt and are engaged in restructuring that debt or potentially selling or exploring options to sell their operations. But we're also seeing some innovation in the mid-tier mining sector with their lower production, being able to really capitalize on that digital avenue, and also to do some interesting things in customizing their rough supply. And I really I point out Lucara Diamond Corporation, which through their Clara system, I think is just doing really some interesting things beyond Clara as well. The small operations are largely on care and maintenance, and it's a question whether they'll be able to resume production at any stage. Much depends on the state of the market and whether rough prices rise again to a certain level that would make their mines economically viable again. So when we look back at our linear view of the diamond supply chain, where are the diamonds sitting? And when we look back at the last 10, 20 years, there's been this sort of interesting shift that's in the early 2000s, my understanding is that the retailers were holding a large inventories, and they weren't scared to build up inventory and hold it in their stores, and there was this turnover of goods, or they assumed that their stock would appreciate. That changed in a dramatic way in 2008 with the financial downturn. They were scared out of holding inventory, and retailers became much more efficient in their inventory management. And the risk of holding inventory shifted to the midstream, the manufacturing sector, which has really endured some very difficult years of teething pains in dealing with that excess inventory that they've held and had difficulty in getting rid of. The coronavirus, in a very short time, has shifted that inventory to the mining sector, and for better or for worse. But what the point I'd like to make is that it's a real opportunity for the industry to realign and rebalance its inventory management throughout the supply chain. And it'll be very interesting from my point of view, to watch how that inventory of rough that's sitting at the mining sector is going to continue to build up in 2020, is going to be filtered through to the market in 2021, 22, 23. We don't want to be in a situation that we've been in the last 3 years, in which the manufacturing sector has borne the brunt of inventory, and there's really that excess polished supply has had an impact on suppressing polished prices and profits. So looking back at our RAPI graph, what is influencing what is influencing then polished prices to firm in the second quarter? Considering that whole supply chain and the double digits declines that we're seeing across the board, polished prices shouldn't have increased. But there are different factors that are at play at the moment from our view, and I've identified 4 that I think are influencing prices, being supply, demand, not consumer demand necessarily, but we'll get into that. The delivery of goods, and technology is another factor. And so when we look at supply, supply has been significantly reduced, and the lack of contract sales, not only from De Beers but Alrosa, represents a fundamental change in the way the industry is operating, and so and so with little supply, there isn't an urgency to sell, to necessarily sell the goods. The polished market is working off existing inventory. Like I said earlier, that the retail and the polished market and manufacturers had enough inventory to satisfy demand that was coming through the pipeline. And secondly, from a supply point of view, we sort of see, regardless of coronavirus, in the last 5 to 10 years, there's been a hierarchy of demand, that there are those best-in-class diamonds that have been in demand. There's a decent quality, slightly lower, there's medium quality, and the least desired goods. And generally, the inventory that's been stuck in the pipeline are of those medium and lesser desired goods that are difficult to move for whatever reason. The best and the decent goods are difficult to find. Particularly amongst the very top quality diamonds, inventory levels had actually declined coming into the crisis. And so, with little manufacturing going on, there is a scarcity of certain categories of diamonds that is helping to support prices. In particular, one example would be DIF goods, that inventory is low and prices are strong. There's also some investment demand coming in that we hear for those goods, but the supply is at a level that it's low enough that the supply-demand dynamic plays into firming prices. So that's from the supply point of view. From the demand point of view, there are two types of demand that affect diamond pricing. The one is retail. There's retail demand for polished from the retail sector, and then there's dealer demand. To deal with the dealer demand, arguably has had a bigger impact on pricing in the last in the last few years. But it certainly has an effect on pricing, and we're not seeing much of a dealer market at the moment. Prices. What happens in the manufacture, in the midstream, that affects prices? Price is determined as manufacturers move goods while new polish is being prepared. So a manufacturer needs to is buying diamonds with presumption or the intention to sell, and then keep the ball rolling, so to speak. So the site system, the rough contract sales system. When I say sites, I guess I include De Beers and Alrosa in this, but the site system plays such an important role in keeping in fueling that activity. Because what happens is that a site holder wants to buy rough from their contract supply, and they need financing to do so. So they go to the bank lends to the site holder, and they buy the sites, they buy the rough. They polish it, takes a certain amount of time, and then they must sell that polish to service the loan, to pay back the loan, and create liquidity to invest in their operations and buy a rough again and make a profit. In the last 2 months, that hasn't existed because there've been no sites, and the banks are also giving leeway to repay their loans. So manufacturers are not buying rough, and they don't have to repay their loans. So polish suppliers are not under as much pressure to reduce prices to create liquidity as one might have expected, so that's again feeding into the firming of polished prices that we've seen. That there's no urgency to sell, so there's no need to reduce prices to entice a buyer into the market. There's also, as supply has diminished, the lower the inventory, the lower their urgency to sell, essentially. So that's the first type of demand that we see. The second is from the retail side of things, and this is where delivery has played into the dynamic of the diamond industry. There've been difficulties to ship goods between centers. So generally, what would happen is that a jeweler sorry, and so that was initially due to air travel disruptions. Cargo is continuing now, but there are delays at customs. That customs officials have also been in quarantine or have also been in lockdown, and on a slower process. And so it's not easy to clear customs as it used to be, and that has an effect on retail demand. In other words, it has an effect on demand from the retail jewelry sector for polished diamonds. In this sector, the demand is the main driver. You don't have that same liquidity issue that you have in the dealer market. That if a jeweler doesn't sell the diamond, they're not going to buy. Especially after 2008, when there was a more efficient management of inventory in the retail sector. So if a jeweler doesn't buy, they're not going to sell. When they do need to buy in this environment, and there is some demand, there is some sales going on. It's not completely dead. There's online. There's, we saw the numbers earlier. When they do go back into the market, there is a lower supply, and so generally retailers had the luxury of being selective, of being picky. That there was an excess of supply out there in the market in the midstream, and they could pick and choose across the globe where they might want to source that diamond from. As shipping has become more of an issue, in a usual situation, then a US jeweler would call his dealer in Tel Aviv, say, who would then call his supplier in Mumbai and make the order. And it would take a certain amount of days, within days, for the diamond to be shipped from Mumbai to New York for that jeweler to pick up. Today, it's not so simple. And so if a jeweler needs a diamond quite fairly, within days, there's no guarantee that he's going to get that. And the same applies for a dealer looking to source goods to fill an order themselves. So there has been a shift to localized trading, which impacts prices in different markets. So if I usually source my goods, I'm sitting in Tel Aviv, I usually source from Mumbai, but I can't do that now because the delay is too much. I'm limited to source my diamond in Tel Aviv, and so the choice that I have of goods is much more limited. And as a supplier, I'm therefore able to hold my price because I know that the buyer doesn't have as much choice as they used to. And so that is another aspect that could possibly be feeding into a support for diamond prices at the moment. The second is the tech revolution, and I'll just go through this quite quickly because I think we are running a little late. Technology was playing a role in driving efficiencies in the diamond market even before the coronavirus. And there's this perception that the industry is not very tech savvy. It's kind of got a bit standoffish towards technology. I had a very interesting conversation with David Block, who's the CEO of Serene Technologies. It was a podcast that we did, and it's published on diamonds.net, where we spoke about this issue. And he made the point that it's really the one segment that really the industry is quite tech savvy. We see that in manufacturing sector that really has adopted technology in a big way in the last few years. Where we might be lagging is on the retail side of things. And so and so when we look at the diamond supply chain, there has been some movement in using technology to create those efficiencies, but the coronavirus experience is really accelerating this as well. That the pandemic is accelerating the process that companies who may have viewed technology with intimidation are realizing that it's quite user-friendly. Suddenly, I'm able to have a Zoom meeting with my work colleagues, and use technology to engage with my suppliers, with my buyers. And so there is a certain hurdle that the industry has been forced to overcome in its view of technology. And moving forward, that technology is going to enable companies to communicate better with each other. It already is. Not only enhancing the ability to sell at the retail level, which retailers are being forced now to sell online in a big way, but also for giving the capacity of companies to source the right goods in a much more efficient way, those goods that shape its business strategy. And so it can read, and we see that from rough sales all through to polished and at the retail side. So I think in the long term, the technology is driving efficiencies in the market that are going to create opportunities to sell diamonds at a premium, and that's something that I expect has been accelerated in this environment. So what are those great disruptors? Just to summarize, the first, the great disruptors that I think are going to stick in the long term. A lot of these changes that I've spoken about, particularly with demand is going to come back. It's going to come back. The dealer market is going to churn again, and jewelers are going to return to the market as their sales improve. But there's certain trends that I think we're in it for the long haul. And these represent real opportunities for the diamond industry. The first is that issue of customizing rough, and that includes that on the contract sales side of things. That we know that De Beers is renegotiating its or reworking its site contract for next year with site holders. And one of the things that they initially spoke about was to really understand where the role of their site holder clients, whether it's a dealer, a manufacturer, etc., or a retailer. And so it's going to, I think that all mining companies are going to be forced to really hone in on that and supply the rough that's suitable for their customers. And it's such a beautiful opportunity for the manufacturing sector at this time to enforce that. And I hope that the manufacturers are empowered in that sense. The second is that we have that there's an opportunity to rebalance inventory along the supply chain, that it shouldn't be weighted across in a certain sector, such as the manufacturing sector, as we've had in the past. But that's going to take some conscious selling and buying within the trade, given the amount of rough at the moment. But ultimately, we want rough. We want a balanced supply chain that isn't impacted by an oversupply, and this is an opportunity, and I think it's something that we can enforce for the long term. And the second, as I mentioned, is use of technology to ensure pipeline efficiency. It's not only in buying and selling goods, but it's also what type of goods, and using technology to ensure responsible supply chains, which is such an important aspect of the consumer experience today. Okay, looking in the short term, we can look at the fourth quarter as an opportunity as well. And when we speak to marketers in our coverage and in our podcasts and webinars that we've done, there are a few things that I picked out. The first is that everyone talks about the travel industry being a big competitor for the diamond jewelry industry. That if a consumer has a certain amount for discretionary spending, they have been spending a lot on travel. Travel obviously is not on the cards at the moment, and I don't think it will be in the holiday season either. That's not to say that experience won't be a factor. And the RV that I think there's going to be a shift during the Christmas period from flights travel to local experiences, road trips, and things like that, which would be my preference anyway. But that localized experience is a cheaper experience than air travel, and there is a certain budget that consumers will have to spend on items such as jewelry, and we need to take advantage of that. It's experiences that count that are going to be the theme going into the fourth quarter for consumers and for retailers. And the diamond industry is so well positioned to take advantage of that, because it combines both experience and value, as so many have spoken about before. That meaningful gift that consumers are looking to are yearning to express their emotions with each other. The diamond industry has that symbolism of meaning, and commemorates the experience that the couple is having at that time, and it really encompasses a real marketing opportunity. And as I mentioned before, I think that there is going to be an increase in bridal, and there is an opportunity in bridal that we should focus on, and that's and essentially it all comes down to marketing. The industry is looking at a new marketing strategy. It launched the Natural Diamond Council in June, and that marked a very interesting shift in how it's approaching the industry marketing effort, in contrast to the Diamond Producers Association, which preceded the Diamond Council, and also different brands that really the diamond, in speaking to David Kelly, who's the CEO of the Diamond Council, they're really emphasizing content. And that is very interesting, because what it says to us that anyone can be an effective marketer. It doesn't require such a big budget. And that's really my message to every company along the diamond supply chain, whether you're a polished supplier, a rough producer, a polished supplier, or a retail jeweler, is that there's so much content out there that you can really play your part in putting in reinforcing a positive message about diamonds. And I would encourage everyone to keep an eye on what the Natural Diamond Council is doing. They have a content page, and I think are more than willing to allow people to piggyback off that. And even if it's, if you see a good story on diamonds.net, to highlight that on social media, to work that into your messaging, is very easy and cost-effective way to do it, and it enhances your business and also the industry as a whole, because it's going to require an industry-wide effort to reinforce those positive messages about diamonds as an appropriate gift in this COVID environment, as we believe it is. So that's all I got to say. I thank you all for listening. I'm happy to take some questions. I went quite a bit over time. I apologize. We're on the hour, but maybe we'll keep 10 minutes or so to take some questions, and you're also welcome to reach out to me if you have any further questions. Okay, so the first question from Kevin is, will I be sharing this presentation deck with the attendees? We send out the webinars. The webinar is published on YouTube after on the Rapaport YouTube channel in the coming days, and we send out a link to that video to review any slides one would want to review. Okay, I'm going to focus. I appreciate all the messages. We got a heartwarming message from Italy about how they're coming out of coronavirus. But even though there's news sources, but it's very encouraging that an important jewelry manufacturing center like Italy has improved its situation from its time 3 months ago. Okay. Vivek asks if we can please show the slide of rough imports in India again. I'm going to encourage you to watch the video or reach out to me. I'll be happy to send you a graph showing those rough imports to India. They showed a second quarter decline of I forget, but it was around 80 or 90%, as India has drastically reduced its imports of rough imports during the quarter. Ricardo notes that India does have difficulty reopening. As I mentioned, the pandemic is still running in that country. Presentation will be available. These are easy questions. Thank you. Is this a good time to shift online? Absolutely, is the answer. That in whatever capacity, and I'm not someone who believes that everything's going to shift online. Brick and mortar is going to play its role in the future, but certainly you always, regardless of COVID, want to be wherever your customer is. And your customer is not only on a strip mall or walking past your standalone store, and your customer is not always in the Boursa when you want to see them. The customer is always online, and so you've got to be there, and you've got to be there in a creative. I'm not sure. I don't know how to pronounce your name, Mr. Agarwal. I'll use formalities, but I'm not sure where you sit on the supply chain, but online is vital in any business, and increasingly also in the mining sector. And I want to emphasize that point, because I think that rough sales need to be revamped, and this digitization of the rough sales process is a very important step that's going to have an influence on the digitization of the rest of the pipeline. Okay, can we view the webinar again? A link will be sent out in the coming days. Georgia asks a question that we asked to Rio Tinto. Will COVID-19 delay the closure of the Argyle mine, and how impactful will the closure be? So our understanding is that it's not going to delay the closure of the mine. Argyle is still on schedule to close before the end of the year, and fully close down in 2021. In other words, production will stop in 2020, and the mine will eventually close down next year. What COVID is doing is that it's giving Rio Tinto an inventory of goods to stay in the market, for Argyle to stay in the market for a longer period. And that question of the impact that Argyle has been such an important mine for the diamond industry, and really driven so many trends in the industry over the years. It was always a question, what's going to happen post Argyle? And in a way, I think this reduction of demand maybe is softening that blow in some way. It's not necessarily a problem we want, or but there will be Argyle goods available, including their pinks in 2021, as far as I understand, and certainly the higher volume goods I would expect will still be around and available from Rio Tinto at least into the beginning of 2022. Kevin says, thank you, my pleasure. And then Kim asks a question about the impact of lab-grown diamonds. I'll tell you that, to be honest, it's not a question I can answer with full knowledge. What we, just in terms of my observation, and this is a beautiful point that David Kelly from the Natural Diamond Council makes, is that during COVID, we haven't heard too much about lab-grown diamonds. There was such tension in the last 2 years about and concerns about the threat of of lab grown on the natural diamond market. And I think what this environment taught us is that really all that matters is us. The natural diamond industry needs to just do what it does and have confidence in its own product. And so the truth is we haven't been as focused in our coverage of the market. We haven't been as focused as we were before on lab grown, because COVID has taken over the bulk of the conversation. But I think it's telling. I think it tells us that if we just focus on the positive things that natural diamonds have to offer, we'll really do okay. We'll be okay, and more than that, we'll be great. And because there are so many positive things to take from our product and from this, and that are so relevant at this moment. So Tanya asks if she missed the beginning of the webinar, but wants to know if she can see the beginning. Tanya, as I said, the video link will be sent to you in the coming days, and if you don't receive it, please feel free to email me. Let's see. Tough question from Jackie. Jackie asks, what would you guess was the trend in retail demand in the first half? And what is your prediction for the second half? Yeah, I mean, as I showed in the slide, Cartier and Van Cleef were showing 60% declines in the Americas, in Europe, in Japan, about 30% in Asia Pacific. I don't expect that such deep declines from other companies. I think we'll see 30-40%, from other US-based retailers. But I do think that there will be some improvement in the third quarter and especially in the fourth quarter. I think the holiday season will be okay. If we look at it from a quarter to quarter basis, the year-on-year comparisons are going to be difficult one way or another. I hope I'm wrong for the second half, but I think the market is going to start picking up from a retail point of view in the coming months, and particularly in the fourth quarter. But the trend at the moment is that retailers don't need stock. They have their inventory. What they're thinking about for the fourth quarter is a different question, and it'll be interesting to see, through at our next webinar in October, we'll be able to answer the question if they have bought in any significant way as they prepare their collections, their inventory, to present something fresh and interesting and fun and new to consumers in the holiday season. Okay, I'm going to take two more questions. Gosh, that's a tough question. Mark asks, how much does supply have to diminish in order for the market to be in balance? As well, are miners coming back online with safe protocols in place? Miners, actually, it's an interesting question, because I've spoken to one or two miners about that, and the impression is that a mine is this enclosed environment where COVID might spread. But the truth is, it's also quite a sparse environment, and people aren't on top of each other, there's some distance. It's not so difficult to distance to implement social distancing in a mine, which surprised me, but also made sense to me. And so they, any miner that I've spoken to has had a very careful planning of their reopening, and I think there are issues of COVID in other mining sectors, in South Africa, but my understanding, I haven't seen anything of significance in the diamond mining sector. In terms of your supply question, I'm going to just say I don't know. I think that's the question that mining companies are asking themselves. At what point do we go back to, at what point are we able to sell a certain volume of the rough that we're holding, and what is the appropriate amount of rough to to release to the market at any given time, so that will depend on demand coming through from the rest of the supply chain, particularly the jewelers who are ordering from the polish suppliers, who are ordering from the manufacturers, and from the mining companies. So it's at the same time, it's very difficult also to make an assessment of rough prices at the moment, and that's another question that remains unanswered. Different tender houses are putting out different reports about, their prices were up by X%, their prices were down by X%. It depends very much on the type of goods that they are selling. And so it's very, you can't make it a general thing and apply it to your rough price index. And also El Rosa and De Beers haven't been selling in any significant way. So when they come back to the market, they're asking themselves, what is the appropriate volume of rough that they need to release to the market, and what is the appropriate price? Because we don't know what their prices are at the moment. So that's something to watch out for. De Beers are publishing their half-year report through Anglo-American next week, I believe, and that's always an interesting read for us, and we hope they'll give some commentary on the market as well. Mining companies, by the way, have been very open and quite accessible to, in fact, everyone has in this COVID environment. Okay, I'm going to take one last question. And it's a question that I'm not so confident in answering, but I think it's an important question to ask. Nick asks, you talk about social distancing due to COVID-19, but what input can you give those of us rough buyers that need to interact face-to-face with artisanal miners of various African countries? How are we supposed to adapt? It's a really very interesting question that I don't have the answer to, but it's certainly given me an idea for our news team to look into. There are various groups that are doing very important work in the artisanal mining sector. De Beers has its Gem Fair program, Diamond Development Initiative. Rapaport is doing sort of a broader social programs in Sierra Leone that started with the artisanal diamond sector and has expanded to various other projects. So I feel a little embarrassed, but it's something that we need to look into, and I would encourage you to also reach out to Gem Fair. I think they might have some interesting information, and the Diamond Development Initiative, DDI, might have some good advice for you. Okay, so I want to thank everyone for joining us. I'm sorry I went a little over time, but it's such a difficult, there's so much going on, and yet nothing's happening, which is kind of it reminds me of my nights out, as a university student. We used to hop from bar to bar to bar to bar, and used to say that everything's happening, but nothing's going on. But that's not the case. There is business being going on, but it's changing, and the industry's changing, and we need to keep abreast of those trends and watch them and shape them. Everyone on this call has a place in the market and an ability to participate in shaping those trends to their benefit. So I wish everyone luck and great health and good health, and look after yourselves. And I look forward to seeing you all soon. Thank you very much.